On January 1st, 2025, China executed a strategic maneuver that sent immediate shockwaves crashing through the global silver market. Beijing officially placed silver under strict state trading export controls, effectively signaling a total lockdown on their metal supply. Industrial manufacturers worldwide panicked as analysts predicted severe shortages, causing silver prices to immediately begin a steep vertical climb. Yet in October 2025, only 9 months later, China reversed course and did the unthinkable with their reserves. They exported 660 tons of silver in 1 month, sending record volumes straight to the London market. This shipment flowed directly into the exact Western market they were supposedly cutting off just months prior. This massive movement was not a gradual policy shift, but a desperate emergency dump of precious resources. The strategy failed spectacularly, because silver prices did not crash despite the market being flooded with metal. Instead of falling, the price hit $66.21 per ounce in December, a historic high. We must ask why China reversed course so dramatically, and why their massive supply injection failed to work. Let us rewind to January and examine the Ministry of Commerce declaration that started this entire chain of events. They declared silver exports would require state approval, mirroring the restrictive framework used for rare earth metals. This created a control system where Beijing could turn the supply tap on or off at their discretion. The message was clear that China was prioritizing domestic needs specifically for their massive solar panel manufacturing industry. Their domestic industry produces over 80% of the world's solar panels, consuming vast quantities of physical silver. Every single panel requires about 20 milligrams of silver paste to create the necessary electrical contacts for operation. With China installing record solar capacity, throughout 2025, analysts expected Beijing to hoard every ounce of metal. However, the official narrative completely fell apart by October when the restrictions were suddenly and violently broken. China did not just ease restrictions, they opened the floodgates and poured metal out to the London Association. To understand the panic, realize this export volume was more than double their monthly 5-year average. We must ask what terrified the world's manufacturing superpower enough to reverse a strategic resource policy in 9 months. The answer lies buried within the Shanghai Futures Exchange stockpile data, and the numbers are truly terrifying. While China was exporting record amounts, their domestic silver inventories were quietly collapsing behind the scenes. Inventory levels plummeted from nearly 4,000 tons in January 2021 to just 780 tons. That represents a staggering 75% inventory wipeout in a period of less than 5 years. China was not restricting exports to build reserves. They were restricting them because they were running out. When the London market began to seize up, Beijing had no choice but to raid their remaining supplies. In October 2025, a crisis occurred behind closed doors that forced Beijing's hand into this emergency action. The London silver market, the global hub for over-the-counter metals, was experiencing a severe physical squeeze. Inventories were so critically tight that buyers were paying massive premiums just to secure physical metal delivery. Analysts confirmed that the crisis stemmed from rising exports to London combined with elevated industrial fabrication demand. London was screaming for silver, and the premiums offered made it politically and economically impossible to refuse. Recall that Shanghai silver was already trading at a 15% premium over Western prices earlier that year. That domestic spread was designed to compensate for China's 13% import tax and to encourage importation. Chinese traders were heavily incentivized to import silver into the country, not to send it away. However, when London offered even higher premiums, the arbitrage trade became irresistible to the state planners. It became necessary to reverse the flow to prevent a complete and catastrophic breakdown of the global market. Senior commodity strategists explained that a wave of imports into China would usually drain on Western free float. But in October, the wave reversed dramatically, and China became the supplier of last resort for the West. They exported 660 tons to keep London's market from seizing and to save the pricing mechanism. This was not a strategic move, but damage control and emergency intervention to prevent systemic failure. Even after injecting 660 tons at October prices, silver prices kept climbing relentlessly upwards. On November 26th, spot silver traded above $52, ignoring the massive supply dump. By December 18th, it shattered previous records, hitting $66.21 per ounce. Think about the magnitude. China dumped 21 million ounces into the market, yet prices rose. This counterintuitive reaction tells us everything we need to know about the supply and demand imbalance. Industrial demand from solar electric vehicles and data centers is stronger than any stockpile release. We now have confirmation that China's Shanghai stockpiles have collapsed 75% since 2021. Their domestic solar industry is consuming more silver than ever, compounding the scarcity problem. The terrifying question nobody wants to ask is what happens when China runs out completely. Let us examine the mechanism driving this market a death spiral that is already in motion. Stage 1 began when China imported heavily, hitting a 3-year high of 390 tons as in December. Stage 2 saw the domestic solar boom consume stockpiles faster than imports could replace them. Stage 3 was the collapse of Shanghai inventories, wiping out nearly 3,000 tons of metal. Stage 4 occurred when London experienced the physical squeeze that triggered the global alarm. Stage 5 was China's emergency export to prevent a total global market breakdown. Stage 6 is where we are now, prices rising anyway, because the structural deficit remains unsolved. This is not a cycle. It is a death spiral with a mathematical endpoint we can prove. Hard numbers from the Silver Institute confirm deficits have persisted for 5 to 6 consecutive years. The 2024 deficit was over 215 million ounces, the second largest in 20 years. Industry analysts project that if China reduced exports by just 50%, global deficits would exceed 5,000 tons. However, China did not reduce exports. In October, they actually increased them by 213%. The fact that this massive increase failed to lower prices reveals that the market is structurally broken. Demand from industrial applications has permanently outstripped mine supply, and China is scraping the bottom of the barrel. China's domestic production was 3,300 tons, while consumption hit 19,000 tons in 2024. This creates a massive 15,700-ton deficit that can only be filled by imports. We just watched them draw down 660 tons in a single month to save the London market. While China was bleeding inventory, India went on an unprecedented silver buying spree that shocked commodity analysts. India imported over 2,600 tons of silver in just September and October of 2025. To understand the scale of this demand, let that number sink in: 2,600 tons. A massive chunk of this metal originated from Hong Kong, a traditional routing point for Chinese silver. Industry analysts suspect this was leased Chinese silver routed through London and then re-exported to India. This reveals the actual emergency supply chain. Metal flows from China to London, then to India. China did not reverse export policy to help the West, but to feed India's massive industrial boom. India is installing record solar capacity as part of their renewable energy transition and growing economically. Unlike the West Indian, consumers prefer holding physical silver, creating both industrial and investment demand pressure. In October, China effectively bled their stockpiles to supply this demand and keep the global market functional. Yet even this emergency injection could not stabilize prices, as Indian futures hit record highs per kilogram. The premium structure in physical markets tells us everything about the desperation currently playing out globally. Shanghai silver maintained a 15% premium over London prices throughout the entire year of 2025. Indian futures showed massive premiums reflecting domestic scarcity, with delivery delays stretching to 3 weeks. This is what a structural supply crisis looks like, not a temporary squeeze that resolves quickly. It is a fundamental mismatch between geology, what we can mine, and technology, what we need. If you want to understand the end game, look at what China did with rare earth elements. In 2010, China controlled 97% of global rare earth production and used export quotas. Rare earth prices exploded overnight, and Western countries launched desperate efforts to develop alternative sources. We are watching the same movie play out with silver, but the situation is even more critical. China produces 3,300 tons annually, but consumes 19,000, creating a massive deficit. The key difference is that with rare earths, China had stockpiles to deploy as a weapon. With silver, their stockpiles are nearly exhausted, with Shanghai data showing only 780 tons. At current consumption rates, that remaining inventory represents less than 2 weeks of supply. Even if they hold hidden off-exchange inventories, the trend is unmistakable and terrifying for industrial users. When China runs out, they must either slow industrial production or bid up global prices aggressively. Neither option is bullish for stability. Both options are explosive for the price of silver. Unlike rare earths, you cannot easily substitute silver in its critical high-tech applications. Silver has the highest electrical and thermal conductivity of any metal, with no close seconds. Physics does not negotiate. You cannot use copper paste in solar panels without losing efficiency. Panel performance drops 20 to 30% with substitutes, which is unacceptable for the industry. For high-frequency electronics and medical devices, you simply cannot use substitutes due to performance risks. This is why even a 660-ton dump could not stop the price rally. Demand is non-negotiable because industry needs silver to function, and the supply is finite and concentrated. Let us do the calculation everyone is avoiding to reveal exactly how little time remains for the market. With 780 tons remaining and monthly consumption at 1,580 tons, the visible inventory covers approximately 14.8 days of supply, which is less than 2 weeks. Even assuming they have hidden reserves, we are talking about months, not years, before exhaustion. Every month that passes, the structural deficit compounds, and the hole gets significantly deeper. By January 2026, Shanghai stocks will likely fall below 500 tons as demand surges. In February, China will either restrict exports again or aggressively raise bids for imports to survive. By March, global spot markets will face severe physical delivery delays as supply chains finally snap. In the second quarter, price discovery will break as paper markets decouple from physical reality. This is arithmetic playing out in slow motion. Global deficits have persisted for 5 consecutive years. The deficit in 2024 was over 200 million ounces and is growing larger. Solar demand is up 20%, and EV adoption is accelerating the consumption rate worldwide. Now add the critical variable. The U.S. Geological Survey added silver to the critical minerals list. This designation allows the U.S. to apply tariffs on silver imports under national security frameworks. As trade tensions escalate, silver becomes a geopolitical weapon in a much larger strategic game. If China restricts silver to counter tech sanctions, the U.S. will respond with aggressive tariffs. Caught in the middle is every manufacturer and investor watching prices spiral out of control. The price will go wherever it needs to go to destroy demand, potentially much higher than today. Technical analysts are now looking at the gold to silver ratio for clues on price targets. Current technical analysis points to the gold to silver ratio, which stands at 65 to 1 as of December. If gold stays at current levels and the ratio reverts to the historical average, silver should be $71. In a panic buying scenario where the ratio compresses to 50, silver would mathematically hit $86 per ounce. But those calculations assume a rational market, and what we are facing is a genuine supply emergency. In 1979, during the Hunt brothers squeeze, silver gained 733% in 12 months. In 2025, silver has already gained 123% in just 11 months. If this rally continues into the second quarter of 2026, we are looking at over $100. Some credible strategists now suggest potential advances to $200 or $300 if supply disruptions persist. When a structural deficit meets geopolitical restrictions, price is the only mechanism that can balance the market. You either raise prices high enough to destroy industrial demand, or you physically run out of metal. There is no third option, no middle path, and no compromise available for this equation. Watch the indicators in January 2026. Monitor if Shanghai inventory drops below 500 tons. In February, watch for Chinese export license approvals. If they tighten it, confirm stockpile exhaustion. In March, track physical premiums. If they exceed 20%, the paper markets are losing control. By the second quarter, price discovery may break completely as paper markets decouple from physical reality. Institutional players like JP Morgan already know this and understand the long-term supply dynamics better than anyone. They paid nearly $1 billion in settlements previously, but they are positioning for the real move now. Central banks bought over 1,000 tons of gold recently, and silver is following that safe haven bid. ETF inflows hit record levels in 2025 as both institutional and retail investors piled in. Awareness is spreading that China's massive October dump failed to restore confidence or lower prices. It failed completely because you cannot dump your way out of a structural deficit. You cannot export your way out of geology, and you cannot policy your way out of physics. The question is not if silver breaks $100, but simply a question of when. It is a question of whether you will be positioned before the crowd realizes what is coming. Shanghai's stockpile sits at 780 tons and is falling every single day. The global deficit stands at 695 tons and is growing with each passing year. The time remaining for this market to function normally is measured in months, not years. The math does not care about your opinion, your skepticism, your hope, or your fear. It only cares about the absolute laws of supply and demand. And right now, demand is winning by a landslide.